Thank you, Marta, and good morning, everybody. It's a pleasure to be here. The goal of my talk is to discuss the current situation, the current macroeconomic situation in the US, and what brought to the current situation, what can we do about it. Okay, so in terms of motivation, so I'm sorry, we don't have the PowerPoint. I do have the presentation here. So let me, to motivate my talk, I guess you can try to take a look at this here. I'm represent, do you see this graph? Yeah. From far behind, I can get closer perhaps. This graph here represents the behavior of GDP and unemployment rate in the recent decade in the US. The highlighted areas represent recessions, and right now the US economy is expanding, but it's expanding very slowly. So if you just try to look very tightly here, you would notice that the unemployment rate, what is really surprising about the current state of the US economy is that the unemployment rate is very high. And the unemployment rate in the US was not that high, and has not been that high for a very long period of time. And despite, so GDP went down during the contraction, the US is expanding, but actually unemployment does not show a significant improvement. So unemployment is still very high, GDP is growing slowly, and so it seems that the US and the world economy is still going through the consequences of the financial crisis. So first I will briefly, in today's talk, I will briefly discuss the circumstances that led to the crisis, so we can perhaps talk about these as causes of the crisis, but more particularly, I want to focus on the effects of the financial crisis, the macroeconomic effects of financial crisis, and then where are we now and what can we do about it. Okay, so I plan to talk for 30-40 minutes, and then I will be happy to answer your questions if you have any. Okay, so what are the circumstances that brought the financial crisis? So the US economy, one of the main causes, if you want to call it, that brought the financial crisis was the significant increase in housing prices that started in 2000, 2001, and peaked in 2006. So it turned out that the increase in housing prices in the US, which affected all states across the board, turned out to be a bubble. So in 2006, the price of houses started dropping, and it dropped severely. So behind this housing bubble, we also noticed that the financial sector, banks, were experiencing a period of significant financial innovation. There were significant changes in the way mortgages were issued. Banks were not holding mortgages on their balance sheets any longer, but they were just originating the mortgage, and they were distributing to other firms, issuing the famous or infamous mortgage-backed securities or collateralized debt obligations. So housing bubble, financial innovation, and it's very difficult to find a cause and effect relationship here. They were all feeding each other. Interest rates in the US were very low, and it definitely that may have contributed to the fact that people were just buying houses as a result. So definitely everything actually, the whole system was based upon housing prices going up. When housing prices started falling, I'm talking about August 2006, then all banks, the whole financial sector started paying for the consequences. And definitely as a result of that, there was while before the crisis, there was a significant credit boom. Definitely credit collapsed. There was a contraction in availability of credit, which led to several banking problems and several mortgages problems. So these are what brought the crisis, and definitely there are some lessons to learn from what brought the crisis, and perhaps we can talk about it after the presentation. But the consequences of this contraction in credit and drop in housing prices was definitely a drop in consumption expenditure. There was less credit, less wealth. People consume less. The US economy was really, the US consumption was so powerful that when it dropped, definitely it led to a contraction in GDP. At the same time, the fact that people stopped purchasing houses and the lack of availability of credit led to a reduction in investment in the US. So we have less consumption, less investment, and this contraction in expenditure led to less GDP. So less consumption, less investment, less GDP. Because GDP contracted so much, unemployment increased sharply as a result. Surprisingly, because in previous crises, the reaction of unemployment to the drop in GDP was not as severe as this one. And actually, there are several explanations for that. Typically, surprisingly, the US labor force turned out to be much less mobile than people previously thought. Why? Because people, when the price of houses dropped, people became so under the water. So they decided not to move out of their state or out of their city because selling the house would have implied some losses. And they decided to be unemployed without the typical labor mobility of the stereotypical American. So definitely the special circumstances of this crisis exacerbated the negative effect on unemployment. Then the drop in consumption and investment in the US had major repercussions in the global economy. So the US-born financial crisis propagated to the whole world through the credit channel. So there definitely was like less credit globally, but there was also less consumption by the US. Less consumption by the US meant that the US purchased fewer imported goods from abroad, and which led to a drop in GDP in other countries. Now, what were the policy responses to this severe drop in GDP and increase in unemployment? On one hand, monetary policy reacted very aggressively to this crisis. On one hand, the Federal Reserve wanted to reinstate credit in the system, so there was definitely, the Federal Reserve over 3 months in 2008 nearly tripled its balance sheet by acquiring new assets, new mortgage-linked assets that actually increased the availability of cash in the system and trying to save credit to the whole economy. And but what actually is interesting is that the interest rates that the Fed was controlling, the federal funds rate, got to zero, like to the lower bound very quickly. So the Fed had to become very creative and introduce more. It's coming. more creative policies that actually tried to save things. So the US, the central bank has been very proactive, but at the same time, it seems that.
Can we
just look.
the length already?
I think this is the best we can do.
Yeah, I think this is the best we can do.
So.
We need to bring it closer.
Nope.
That's okay. That's fine.
It's not changing slide.
the other one. I don't think it's connected to that one.
No,
Is
this
it?
is this one. Yeah. This one.
You know what?
Maybe you can, yeah. You want me to do it here on my side?
Yes.
Okay. Just to get the lunch. I'll take care of that. Just make me a signal. Okay?
Okay. Sorry. It's still a visual exercise. So,
Make sure that you recognize all the letters.
so there was the need for a monetary stimulus, and these are the objectives. So stimulate consumption, investment, and GDP. So contrast the negative effect of the crisis. So these are the policies. We can just change slide. These are the policies that the Federal Reserve followed. As I said before, the balance sheet at the Fed nearly tripled in 3 months, and the Fed is still continuing this attempt to stimulating economic activity. But again, there is a limited room for monetary policy. Monetary policy, that used to be like the central way through which governments were affecting the economy during the crisis, did not work that much. Because interest rates got to zero very quickly, and so there is not room for traditional ways, and there's a need for perhaps less conventional interventions. So now, on the other hand, fiscal policy, which was not as it lost importance in the way to in its discretionary way to stabilize the economy, got center stage. So monetary policy didn't work. Fiscal policy was used by the US and by other countries in the world with the idea of stimulating GDP by stimulating government spending. And as a result of increasing government spending, this should have increased employment, GDP, and stimulated consumption. Okay, so that was the idea of using fiscal policy as a stabilization device. In the spring of 2009, the US approved a very $900 billion of an American Recovery and Reconstruction Act that actually was characterized by a cut in taxes and an increase in government spending. Then we discovered that this policy, the fiscal stimulus, was indeed effective, but it was actually followed by several countries in the world, and it had the problem of deteriorating the government budget. Okay, and the government budget in the U.S. was already under pressure before. Would have been under pressure before this fiscal stimulus. Okay, but it did work. So as you can see here, the government budget deficit, the government budget in the US was in a surplus in the late 1990s. And it became a deficit following 9/11, 2001. But as you can see here, you see the significant drop of the government budget deficit that reached 10% of GDP in 2009. And there is a slight improvement, but we're still in this neighborhood, which, things need to be done, okay? So we need to do something to fix the budget. So this is not specific of the US only. It's a common problem of all the countries in the world that try to use the fiscal stimulus to actually stimulate their economy. Now, let's take a look at where the US is right now. So the US has been in an expansion, so the recession is over, technically. The recession is technically over, but GDP is stagnant. So GDP is growing, and it's growing very slowly, and too slow relative to what we would have needed to increase employment and to reduce the unemployment rate. There is no inflationary pressure, so it seems that inflation, for now, is not a problem. And that's perhaps explained by the fact that GDP is stagnant. What is actually worrying is the fact that consumers and firms are not really willing to buy things, okay? And this is perhaps is linked to the current state of the economy, but definitely expenditure has not picked up relative to what we were doing before the crisis, which could be a good thing on one hand, because people are becoming more forward-looking, but at the same time, there's a lot of firms who are sitting on a lot of cash, but they don't want to buy new equipment, new capital goods. And the financial sector, perhaps with the linkages with Europe, the global economy is definitely under a lot of stress. And so banks are potentially a source of significant uncertainty to the whole global economy and the US economy in particular. Unemployment, which is actually more specific about the US, has not returned to normal. As you saw more or less from the graph that I showed you at the very beginning, unemployment is still very high, it's still close to 10%, and it doesn't show a significant trend for an improvement. And that's a very important policy question that needs to be addressed. And again, fiscal weaknesses, okay? So there's severe budget problems, and there's policies that affect politics, and they do have important repercussions on what needs to be done. So let's take a look at the next slide. And what is actually interesting here, there is an interesting dichotomy between what needs to be done in the short run, like with a urgency, but actually what also needs to be done on what economists call the long run. Okay, so and there is a sort of a trade-off. Is there a trade-off between what we need to be doing in the short run, so if you could, or in the long run? From the short run perspective, we need to make sure the GDP increases as soon as possible to make sure that people are hired, so unemployment goes down. The long run perspective is to do what? We need to make sure that the budget deficit is fixed, but so then in the future generations will actually will have enough capital to grow. Okay, and from the economic textbook viewpoint, it's possible that these two objectives are a clash between each other. On one hand, stimulating the economy now is going to have negative long-run consequences, or focusing on the long run may have short-run consequences. So that's a difficult policy and political issue that perhaps is being addressed right now, and that is why it is a debated, it's a real dilemma. So some questions that people are still arguing about, because macroeconomic is still very controversial. People look at it from different perspectives, is why is the unemployment rate so high in the US? And one explanation is that the unemployment rate is so high in the US because there is not enough demand. People are not spending enough. So the policy implication of having an unemployment rate explained by cyclical factors, so still talking about the business cycle, is that the US economy needs a short-run solution, further stimulus, okay? And monetary policy does not work, fiscal policy seems to be working, but can we afford to increase spending right now, okay? That's that, but if unemployment rate is due to the demand, that's what we need to do. On the other hand, if the unemployment rate is due to structural factors, which are unrelated to the business cycle, most typically, if the unemployment rate is due to the fact that there were several people working in the construction sector that have been laid off, and for them, it's very difficult to find a job because they don't have the skills that are needed in other sectors. So if unemployment rate is due to structural factors, it's very difficult to find an easy fix for them. So different economists and different schools of thought have different views on what characterizes unemployment now. People who believe that we need to stimulate in the short run are focusing on unemployment explained as a cyclical factor. The other people are going to tell you that what we need is skills, okay? They just look at a mismatch between what firms want to have and what workers' characteristics are, Okay, so that is an important policy question that is still an object of debate currently. As another reference that I was talking before about the clash between long run and short run, what would be the long run consequences of a short run stimulus? So if we believe that unemployment is due to cyclical factors, we may expand government spending, but then what is going to be the effect on future generations? Future generations are going to be are going to carry the risk of a potential fiscal crisis. And people don't want this to happen, because definitely we're seeing what is going on in Europe right now, and it's very hard to find an easy solution once a fiscal crisis hits. And future generations may be hurt because they will be having more taxes to pay as a result of the current borrowing, and there will be perhaps fewer capital stock, or a smaller capital stock to work with. So these are important questions that need to be addressed. So when we're finding a short-run solution, we need to think at what is going to happen in the long run. At the same time, it's been shown that being unemployed is very costly to future generations as well. So it's been shown that especially when a person is unemployed for a long period of time, he or she is going to pay for it 30 years after this unemployment spell, and the offsprings of the unemployed are going to pay for it. So future generations may pay anyway, just because of the high number of unemployed in the present. Okay, so the next, now let's take the other perspective. Suppose that we're going to prioritize on fixing the government budget. How do we fix the government budget? We need to increase taxes. We need to reduce government spending. But this is going to be we can see what happened in the UK when these policies happened last years. There were so high expectations about we're going to focus on the budget first, but it turned out that these focus on the long run only is actually having a contractionary effect in the short run. And this is going to exacerbate the unemployment problem in the present, and it's going to have perhaps even consequences to future generations for what I told you before, and it may generate some social problems as we perhaps experiencing right now. So, is it possible to achieve both objectives? We just focus on the short run and on the long run. Can we do both, or are they really incompatible things we need to think about? Perhaps, even though the situation is very dangerous right now, it's very delicate. At the same time, this could be an opportunity to actually look at what we can do now and what can be done over the future. So perhaps a good policy is one that is actually going to address both components and is going to perhaps stimulate the economy in the short run, but with significant changes on the path of government spending and taxes over the next years. So typically governments are not very good at committing what is going to happen next year. They always claim, next year it's going to be tough, but then when next year comes, they just press the reset button and they just do it again. So it would be, this was an opportunity to actually be consistent with your promises. And definitely, the fact we're close to the presidential elections in the US, it's just not making this discussion very easy. But indeed, there are some commissions in the US that are trying to do that. They're trying to actually take into consideration all the possible steps that need to be addressed between the short run and the long run. So, what is actually interesting is, again, we are getting into the political arena, and even though taxes are always a very debated issue for politics and economic policy. So Bush G.W. Bush, 11 years ago, cut taxes, cut personal income taxes. And this Bush tax cut was assumed to expire, was expected to expire last year, in December of 2011. It turned out that the Obama administration decided not. This Bush tax cut did not expire, and what are the options available now? So should we increase? Should we let the Bush tax cut expire? So should we have an increase in taxes across the board, or shall we not do that? So it turned out that one easy fix to increase the government revenue, tax revenue, would just be let the Bush tax cut expire. Definitely there will be an increase in government revenues, but neither side wants to do that. Republicans are actually in favor of making the Bush tax cut permanent. Okay, so Republicans are in favor of perhaps on the incentive effect of cutting taxes. So if you keep taxes low, then the tax base is going to increase in a certain way, so the cut in tax is going to pay for itself. Okay, that's perhaps the idea that motivates the more Republican view of cutting taxes. The Obama administration is actually not in favor of letting the Bush tax cut expire, but actually it's going to change just a portion of the tax cut. The people with lower income should still benefit for the Bush tax cut, because the Bush tax cut addressed everyone, not just the rich. But the Obama administration is actually in favor of increasing taxes on the high-income individuals. And definitely this is the origin of the struggle, and it's a source of significant negotiations, and it's not an easy negotiation. So, but what needs to be done for sure if we want to increase tax revenues is perhaps reduce what are known as tax expenditures. In the US, in several countries, there's many deductions that people subtract from their income before paying taxes. Typically, mortgage payments, or healthcare payments, or educational linked expenses. So these are all and typically high-income people have greater deductions. So one way to collect more taxes, even if we keep the Bush tax cut permanent, would be to eliminate these tax deductions. It turned out that eliminating the status quo is very hard. Can you imagine people who were deducting their mortgage payments every month? Now they cannot deduct it from their, it would be very difficult, and it would actually put a lot of stress on the housing sector. So it's still, but this would be an easy way to collect more taxes. And I think definitely we're going to go in this direction. So there will be fewer tax deductions, okay? And then perhaps on the table is the idea of introducing a European-like VAT tax system instead of the sales tax that people have in the US, but there is a big debate on this. It seems that neither part likes it. Republicans don't like it because they're afraid that this is a very efficient tax that collects a lot of revenue. And so they're afraid that if we collect a lot of revenue, then there's going to be a demand for more government spending. So paradoxically, Republicans don't want it because it's too good. And
Is your interest to point, because not everybody is familiar between the difference between a sales tax and a VAT tax.
the sales tax, if you purchase something in some stores in the US, you would have noticed that you pay taxes on the final good that you purchase. So you pay, the tax is not included into the price. You pay tax as an additional to the final price. VAT tax is a tax that affects any activity of the production process, of the value chain. So basically, we are taxing each stage that adds value added, and the final price already includes this value-added tax on all. So definitely, it turns out that is an efficient way to collecting taxes. And right now, the sales tax in the US is state determined. Each state in the US has its own state tax. A VAT would be a federal VAT tax. So perhaps people were afraid of the greater power grab don't want this to be introduced. So the next slide still discusses, on one hand, it's a very crucial point of the US economy and in the global economy. So there is a big debate on what to do with taxes, but there is an equivalent big debate on what to do on government spending. Okay, so because we need to reduce government spending, politicians, government, the Congress, have to find a way to find what are the priorities for a nation. Okay, so if we cut our spending, what do we focus on? So if you notice, when Obama discusses the cutting government spending, he never mentions what he's going to cut, but he always talks about what he wants to spend money on, because he wants to clarify what the priorities for his budgeting are going to be. Okay, and which makes a lot of sense. So one thing that needs to be done, again, the US would have been under a fiscal problem even without the financial crisis because of structural reason. The baby boomers are retiring in this decade between 2011 and 2020, so it was already expected that something had to be done for the budget. So we need to find some ways to rationalize especially Medicare expenses, because the cost of healthcare in the US has increased a lot, and perhaps it's a good thing because people are getting a better quality care, but higher price for healthcare does not necessarily translate in better healthcare quality. Okay, so that's definitely an important thing that needs to be addressed. And again, how about stimulating the economy by cutting spending and focusing on priorities given by infrastructure and by investing in human capital. So definitely the US is in need, and perhaps there is a big debate on what to do with education, because several states are laying off teachers. In New York City laid off more than a significant number of people last night. And so it's interesting, it's important to understand what the priorities are, and especially because the US is indeed part of the global economy, and finding priorities also indicates that it's important to be prepared for a greater level of competition globally. Okay, so to conclude, we saw that the US is recovering from the financial crisis, but it's not the recovery is stagnant. So there's still important issues that need to be addressed, and we're even though the US is expanding, the effects of financial crisis are not over. Okay, so we learned several things about monetary policy and fiscal policy. We learned that monetary policy is not always effective because the interest rate channel may be limited when you cannot cut interest rates more than 4% if interest rates were small to begin with. Fiscal policy turned out to be very effective, but it has very important long-run costs, and we need to always consider them whenever we use fiscal policy. So a good way to understand the effect of policy is to be honest about how we're going to pay for the short-run fixes in the long run. And definitely, politically speaking, it's very hard to not use some budget gimmicks or things similar to that. And so, at the same time, we are experiencing right now a very harsh political clash in which the different parties are very polarized. And they're really fighting in terms of economic policy on what we're going to do with taxes. Who is going to pay? You know, it's a very difficult situation. We have to cut spending, we're going to have to increase taxes, and who is going to suffer from it and who is going to benefit from it? So that is why it is indeed a very interesting situation, but it's very delicate at the same time. Okay.
One quick question for us to open on the current months and current weeks. In Europe, we've been in sort of here of looking at the European situation? How do people see it? And is there something to learn or not to learn?
I mean, definitely here people are concerned about what happens in Europe. They're really vigilant, but I think they're more concerned about what happens to Europe from the point of view of financial markets. There is a big scare that Greece is going to go bankrupt. There could be contagion to Spain and Italy, and what would be the effects on the credit, on the stability of the financial system. So that is the biggest fear. The US is such a large country, so I think the fear that people are perhaps vigilant and see what happens to Europe to say, what can we do to prevent what did not happen in Europe? And I think definitely what happens in Europe right now, this is my view, is definitely teaching you a lesson. And the lesson is that you do not want to be hostage of difficult situations when the panic of a fiscal crisis starts. To give an example, Italy. Italy, has many reasons to be under stress, but after the market problems of the summer, there was a very serious and very severe introduction of cuts in government spending, increasing taxes. So theoretically, this should have convinced markets, but at the same time, it was not sufficient to do that. So that's a situation in which it's very hard to find any solution. So you really do not want to get to a point where Italy was, because Italy had a high government debt for a very long period of time, and they did not want to fix it when things were good. So it's very hard to fix your budget when things are bad, because it indeed will contract, and this is for Italy, but also for Greece. If you do when things are hard, are tough, you're going to make it tougher. So you want to fix it when things are good. So that is definitely one policy lesson that we learn from Europe. So that's why people here in the US basically said, we really need to fix the budget. We don't want to be the new Greece, which is perhaps used as a political weapon, but it is a kind of a lesson for the US as well.
So one interesting aspect also from the readings that you shared is this discussion, this collide between austerity and cutting government plans that actually help also lower income classes, and the fact that actually in the US there is a growing inequality and has been the case for the past 15 or more years. So what is your take on that?
I mean, inequality is a problem regardless of the unemployment rate. So inequality has increased in the US in particular, but it has increased globally. It has increased in Europe as well, and in developing countries. So typically, a very deregulated economy is actually specializing and is taking advantage of the competitive advantages. And it's actually creating, even though the country as a whole, the GDP of a country goes up, some people may benefit more than others, or some people even may be hurt in a country. So economic theory tells us that it's still good if the ones who gain may compensate the ones who lose. And so this perhaps was used as a justification to increase the efficiency of the economy, but this compensation between the ones who gain and the ones who lose did not happen. So indeed, the increase in inequality is an important thing that needs to be considered in the current policy discussion. So indeed, there is the greater the polarization of the political parties is definitely affected by the increase in inequality. Yeah. Yes?
You said that workers are less mobile now because of the crisis and because of the GDP problem.
Yes.
Is there a wide number of job offers not completed? Is there an environment on one side and job offers on the other, and they are not matching? Or?
Definitely. So that's in the debate on whether the unemployment rate is cyclical or structural. If it were structural, it would be a situation in which there are some job offers, people are looking for some skills, and they're not able, as you're saying, they're not filling their job offers because they don't find people with the same skills. So it turns out that unemployment rate has increased across the board, geographically speaking and sectoral speaking. Okay, so that is an evidence that the unemployment rate is cyclical because it seems that it affects all over. But it is true that there are some demand for some skills. So there is still a portion about the structural story that is indeed correct. So there are in some countries, the unemployment rate is different in different states. Some states have a greater unemployment rate than others. And typically the states that have higher unemployment rate are those who experience a greater drop in housing prices. Okay, so that tells you that indeed this reduction in mobility makes sense. Makes sense, but also there is a greater demand for certain skills that people don't have. At the beginning of the summer, for example, Northern California was hiring several engineers and several skilled people. So definitely one characteristic of the inequality right now is that the skill-wage gap, the gap between the wage of skilled individuals and low-skilled individuals has increased a lot. And so that is going to tell you that a little bit there is a greater demand for skilled characteristics, and the market is not providing. So this separation between the skilled and unskilled wage is actually telling you that indeed there is some structural pressure. So the thing is, indeed, both stories make sense. Yes.
A short bit about, maybe it is a foolish question,
No.
the impact of the war in Afghanistan and Iraq, not only on the budget, because it is negative,
Mm-hmm.
but could we consider that there is an impact on the GDP, maybe positive?
Definitely. I mean, on one hand, I mean, the spending for the war spending for the war is a typical Keynesian stimulus because it increases government spending and it increases the level of economic activity in any country. So it is true that that stimulated GDP in the short run. Then you can make a case that spending, such a significant spending for the war, increased the government borrowing. If you remember the graph that showed the reduction in the government, the deterioration in the government deficit here. So here we're talking. This is 2000. The U.S. was so here you see 2001. That is the spending. So there was a significant need for government borrowing. Then things got slightly better, not because government borrowing ceased, but because GDP went up. And this GDP went up could be due to what? Spending, the Keynesian stimulus you were referring to, so it's not a foolish question, and also the increase in spending on houses. Okay, this explains the improvement. This is a government debt over GDP ratio. But then here we're saying this. But it's true that spending for the war is a stimulus, a short-term stimulus.